Stanford University.
I wouldn't say the exact beginning, but I've been out here since '71, and I was lucky enough to be able to get a master's degrees in computer science and computer engineering here at Stanford, and that set me up to see the Valley grow quite a bit. So Ernestine forgot to mention a couple things about herself. One, she is a Kauffman Fellow, and she was the first and only Kauffman Fellow in history as an undergraduate, which is a big deal. And second, besides being a venture capitalist and running this course and all, in her spare time, she's getting a PhD in engineering and an MBA. So you just can't keep up with that lady. So first, I want to give a little sort of VC background, a sort of migration, just for a few minutes. Everybody thinks venture capital is a brand new thing, and relatively it is. The venture capital, as we know it, started right after World War II, and there were several people. There was one group that started in World War II, and then there was another general who started one of the first venture capital companies. His name happened to be Draper. And so when you see Bill next week, there are 4 generations now of venture capital. He came out here in the very early '60s, and the first company he founded was Draper Johnson, and that's let's see, I was trying to think of it. Johnson, Pitch Johnson. He calls himself Pitch because he was the pitch man. But and then he founded Sutter Hill. He really is one of the original ones. To put it in perspective, Kleiner Perkins wasn't started until 1972. So you're going to get to see a really, really cool guy who is just sharp as a tack. And of course, between his son and his grandson now, they're, as I said, four generations. So you break venture capital in the Valley up into the '60s and '70s, and then the inflection point happened around 1980, and then we go to the bust in 2000, 2001, and then we go to the last decade, which is called the lost decade in VC, and so I'll walk through a little bit of that. There was hardly any venture capital actually really around through the late '70s. But we had 2 game changers that happened that really made venture capital and ultimately this Valley. The first was the ERISA Act, which started around 1972, but in 1978, they made ERISA is the Employee Retirement Income Security Act. And it's a really big deal because the most massive amounts of money anywhere are in retirement funds. And they fund lots of things like venture capitalists and private equity and all sorts of stuff. But until 1978, they couldn't invest in high-risk investments. They changed the rule in '78 and said up to 10% of your money could go into high-risk investments. So all of a sudden, there's a huge pool of money starting to come in. As a matter of fact, in 1 year, in 1978, there was $39 million invested in venture capital. In 1979, there was $570 million. Now, the next big inflection point was in 1982. That's when President Reagan lowered the capital gains tax from 28 to 20%. Now, that's a big deal because the venture is paid off as long-term capital gains. The way the law works, just a little background on venture capital, the way the tax laws work, the funds is invested, and each one of the partners have to put in so much of the actual fund. It's usually a total of 1 or 2% of the fund that they're investing along the way. Therefore, they're considered to have ownership in the fund, and there's a loophole in the law that says when you actually start getting returns, as long as it's over a year, it's all long-term capital gains. Now, that's a really big deal because the funds are set up the basic rule, and it varies a little bit, but a fund for the partners, there's first a management fee, which runs 1.5% to 2.5%. That's what we pay ourselves a salary with. We call it draw, and that's what we pay all the costs of running the office and having all the nice food services and all that kind of stuff, and taking our folks all out to dinner and all that kind of stuff. But then there's carry, and carry is the big deal. Carry is you get so much percent of all the gains. And so the way it normally works is up to about 3 times the value. So if 100 million was invested, up to 3 times the value after the first 100 million is paid back, you get 20%. So that means if it was a $100 million fund, you get 300 million. The partners get to split $40 million for that other 200 million. Then beyond that, 2 things happen. One is you get 25%, but in a very short period of time, you get to make up that extra 5% all the way down. So if you make, let's say you make a $500 million profit in that fund, well, 125 million is going to be split up between the partners. And that's long-term capital gains. So that's a really big deal. Now for the limited partners, there's an even better benefit. Not only do they get all these multiples and all that on their return, but because of the omnibus tax bill of, I think it was 94, Bill Clinton passed, there was a specific provision to accelerate investment in venture capital. And that is, if you invest, whether you're a private individual or a limited partner, in companies before they have a value of $50 million, you're taxed at half of capital gains. So now you go through all those leverages. Those are the leverages of why there's so much money in venture capital, because the returns are highly leveraged, but they also are taxed much less than anything else. So it's a pretty good deal if you win. And through the decades, we've won a lot. Now first let's talk about the amount of money in venture capital. I told you that we got up to 560 million in that one big jump in 78. By 80, it was $1 billion. It took all the way to 1990 to get to 10 billion. Now we have funds that, NEA just raised a $4 billion fund. Warburg last year raised a $12 billion fund. There's been a lot of money raised. Warburg, it doesn't get all counted as venture because they've turned mostly private equity today, but there's probably 10 funds that raise multi-billion dollar funds on an ongoing basis. So that 10 billion in 1990 went gradually up and then started spiking, and in 1997 it was $70 billion invested. That's the peak year of investment. So then the bust happened in 2000, 2001, and by 2003 we were back down to 10 billion invested in venture capital. The bottom just fell out of the market. Nobody wanted to invest in it, and I'll tell you some other reasons in a few moments. But then it started gradually going back up, and we're back up to 50 billion now. So, it's actually 48 billion last year. So there's a lot of money. Now, let's talk about the history of returns. The way you count your returns when you measure your fund is IRR, internal rate of return. And that is, okay, the fund's, within 5 years, we return X number of percentage. You normalize that percentage, and it comes out to 25% a year gain for every year that you had the investment. That compounds, of course. That's IRR. So the goal of a venture capital company is to do at least 25% IRR. So history of IRR, in the 80s, it went from 10% to 20%. So that was starting to look pretty good. And then it jumped through the roof. By 1996, it was at 80%. I mean, that's crazy. I mean, that's just like, it's it's almost doubling every year the amount of money you invested. I mean, give me one of those, give me one run like that, and you'll be through the roof. It was back down to 0 in 2000. And we're back up to around 20 now. So that gives you a little sort of rule of thumb of what's gone on. If you'll talk about this valley, the 70s and 80s was the period in which it really started to climb. Most of the big name funds that you know were formed in the 70s, and the really big name funds, not all of them. Andreessen Horowitz was just formed 7 or 8 years ago. Let's see, Linus would know exactly, I presume.
Yeah, 2007.
2007, okay. 7 or 8 years ago, there we go, pretty good guess. So what was happening then? In the 70s was what I call, was the era when semiconductors was what I call building out. So, in the phases of innovation that have built the valley, they go through, about every 10 years we start a new one. They go through three phases. The first phase is invention, boom, and bust. And that was the 60s for semis. And, was certainly invented. There was a big boom in funding semiconductor companies at the end of the 70s. And then there was a big bust and a recession in the 71. But what was really happening in the 70s was the build out. Now, build out is where the real value is created in the companies. This is where you actually make things workable. You get the business models together. As far as semiconductors were going in 1970, Intel was hand assembling memory chips. You're not going to get many computers if you hand assemble them. So we had to invent semiconductor manufacturing equipment, and we had to invent tools, CAD, CAM, in-circuit emulators, so mere mortals could use those things. And then we had to consolidate down from dozens to a handful, because if you're Collins Electronics and you're about to bet your next 10 years on a design, you better understand that the company's going to be around. Anyway, so what was going on that was making the money in the 70s was mostly around semiconductor companies that were starting to really build out. The third decade, by the way, is commoditization, and that was the 80s for semis. And what happens then, of course, is you got this experience curve that happened really quick. New chip had come out at $100. Within 6 months, it's at $10. By the end of the year, it's at $1. And then we invented foundries, so you didn't even have to pay for your fabs anymore. And the things went crazy, and there were chips everywhere, and you could build mass quantities of things. So that was happening, and lots of folks were investing in those. There was a combination of East Coast and West Coast companies at that point. For example, Venrock, which was a Rockefeller company, they funded a few small companies called Fairchild, which was the father of all of, the story about the Traitorous Eight and all that. Intel and Apple, so they had a pretty good ride. They're still around. They have offices out here now. But most of the folks were out here, people like Ben Rosen and Bill Draper, and that's when Kleiner and Perkins were first doing their big investments. The 80s shifted. The 80s shifted more towards smaller, the computers themselves. So the computer part was the invention of computers as we know it, not mainframes, but actually mini computers and PCs, which turned into the servers and the stuff of today. Were all going through their invention period in the 70s, and they really began to boom, and they spawned the software industry. So what the big investments going on in the early 70s were in PCs, PC retail stores, the first tablets, and then software. And so, we had an interesting period because Apple went public, I think it was 1981, and then there was a mini recession that went on 83, 84, and then, but there weren't really any tech companies that went public until 86, and within 3 months, 5 major tech companies went public. Let's see, it was Microsoft, Oracle, Adobe, Sun Microsystems, and I'm spacing on the 5th. And then the boom at the end of the decade started to go. Then we went into the 90s. Now the 90s was actually, 90 through 96, was a really interesting era because what was really being invested in was the network, not the internet. There was huge consolidation going on in the network and build out. You know, this Cisco consolidated about 5 or 6 companies. Juniper came along, and the network was the real big build out. That's where all the money was being made. Even though we think of that decade as the dawn of the internet, it was, but it was the invention, boom and bust, and that's what caused the really big bust, because after, first it was Netscape that went public in 1995 that started to really launch that boom, and that was Mr. Andreessen himself. Jim Clark pulled him out of college. And they started this company with a bunch of folks that he went to school with, and it's just started to go crazy. And they didn't raise any venture capital until it was time to go public. And then they said, oh, we need a venture capitalist to help us go public. So John Doerr was the big name then. He's still a big name today. And they went to John Doerr and said, will you help us go public? And so that was one of John's first unicorns. And then the market really took off through December. Gradually started to take off with internet companies. 95 was when Java started to hit the scene, and everybody, including Microsoft, adopted Java. And by the way, first generation Java totally failed because it was meant to be a replacement for HTML. And of course, it didn't really replace HTML. And over the next few years, it was built out as a server-side technology. And that's what really caused a lot of the boom, was those things happening. But in December of 95, Alan Greenspan made this comment that you may have heard about in history, that the market was suffering from irrational exuberance. So between December of 95 and, this was December of 96. Between December of 96, when the boom was really starting to go, and April of 96, not one high-tech company went public. There was just like, the market was down. And I happen to have the honor to be the first high-tech company to go public on April 11th of 97. And we started with a price on our cover page, and as I went out to brief on the tour, all the different potential investors, the market kept creeping down. I mean, like hundreds. We would go into a meeting, and this is the day when people had these little pagers, and they'd be pulling out their pagers, and beeps would be going off, and market got out in 200 points. Meanwhile, I kept lowering the price on the IPO, and I finally had it at $6 a share. And I told Goldman Sachs, if you can't go at $6 a share, I'm pulling the IPO. And by the way, I'm cutting it in half. So we cut it in half. Went public the next day. That day was, to history, the third largest percentage drop on the Dow since the Great Depression. But we squeaked out there, and market limped along, and then started to get a little momentum in May, and then in July we were up to $18 a share, and then we're up to $24 a share, and we did a secondary, and at my company at 3.5 years old, we peaked over $1 billion in revenue, and then 4 years later we peaked over 30 billion in market cap, 30 billion in market cap, and then the bust happened, and we went back down and eventually sold to Oracle for $8.5 billion. My little pride part of that story is I worked for Sun for 10 years. I ran software development. I founded the professional services and federal divisions. And Oracle paid less for Sun than they did for BEA. So that was kind of fun. But whatever happened at the end of the 90s is everybody who could spell venture capital went out to and had any sort of, I worked at Goldman for 2 years right out of my MBA school. Oh, can we give you $100 billion to be a VC? Hundreds of VCs. And of course, 3 years later, half of them were gone, and they were all passing their money back because everybody looked like heroes. The market got so crazy that the time from a company being founded to be doing an IPO was less than 3 years, and it was really crazy times. when the bust happened, it really happened. I think in the first 3 months, 800 companies went out of business. In my business, we were number one. We had the biggest market share. IBM was number two. Then we had 3 smaller competitors. Our sales collapsed about 25%, and then a year and a half later, we were back up above that again. We were over $1 billion in revenue that year, and that's when I stepped down as CEO. Our 3 competitors, their sales went down to 50 to 80%. I mean, it was just devastating the valley. People being laid off left and right. The only good news is you could drive in the freeways without waiting for hours, but it was something else. So the last decade, 2000 to 2010, it's known as the lost decade for VC. The returns were as bad as they ever could be. There were a number of reasons. One was the bust, and people didn't want to do that. 2, there had been massive overinvestment in enterprise and servers and fiber optics, and people couldn't figure out how to monetize that, so they were focusing on it. And 3, Sarbanes-Oxley, if you know that bill, changed the way you have to do accounting and all sorts of rules on it. And it very disfavored venture companies being able to go public. And number 2, it dramatically raised your costs if you went public. So we went from over 60% of monetizations of venture companies in the 90s here in the Valley, ending in an IPO, to around 12%. So, and it's still about 4 to 1 M&A, good exits are M&As as opposed to IPOs. Used to be, you could get to 30, 40 million in revenue, be profitable, have enough visibility that you're not going to fail a quarter or 2, that you never want to do that when you go public, and you could go public, Now you got to be 75 to 100 million and have that kind of visibility, and unless, now there's always exceptions, where there is a little bubble is in some of the real social things, and you see that where they get a little bit crazy. But so far, the world's built back into it. Now what got invested in the last decade was the big build out of social, I call it free reach. And it started with Google, of course. Google happened because they had a really, really good search algorithm, no doubt about it. But they also had 2 other things that happened at the same time that made them the leader. Number 1 is broadband was rolled out. In 1999, less than 1% of homes had broadband. And these little phones didn't have 3G. So the way you got on the internet was that old AOL, you've got mail, all that kind of stuff. And nobody was spent much time on it. Well, between 2000 and 2004, half the population in homes in this country had Wi-Fi. And guess what? Things could happen. The other thing that happened to Google is they found this AdSense model. And it was done by a company called Overture in LA, which was bought by Yahoo, which Google stole, which they were sued for, which ended up getting Yahoo $1 billion worth of their stock before the IPO. But they did it right. Tim Kugel's a good friend of mine. He was the CEO of Yahoo at the time, and he said, I can't blame them. We did it wrong and they did it right. But the other kind of things that were being invested in were the few survivors from the last decade in the first internet boom. Amazon, eBay, Salesforce formed a whole new model that replaced the previous models. So that was what was going on in the last decade. It was a bad decade. Our first fund and our fund that Ernestine and I are in was 2006. We now have about a 380% return, and we'll probably end up another maybe 5 times, but a 380% return. We're the 3rd highest return fund from that whole year. And that, if you take that IRR, it's fine, it's high 20s, but it's not the kind of things that we've been talking, that they were talking about in earlier times, or that I talked about in earlier times. This decade is going to be the highest creation of value in the history of the world. And the reason is that we have two build-outs going at once, and that's never happened before. And these build-outs are synergistic, so they compound one another. One is the cloud, Internet of Things, the whole supporting structure that drives costs and availability down like nobody's business, allows creation of whole new types of business models that we haven't had before. It itself is being built out. It will evolve into a utility, the massive price wars. It's going to be amazing the end of this decade and then the next decade when we have all the commoditization. But the other thing that's happening is we have all the social where everybody can connect with everybody and everybody can do different things. We're now building out the models to actually monetize that in business sense. So that's what the Ubers and the Airbnbs are. You know, in my 40 years since they called this valley Silicon Valley, every place in the world said they're going to be the second Silicon Valley. Well, I had a mirror meeting with a couple other guys with Mayor Lee in San Francisco 2 years ago, and I said, congratulations, we finally have a second Silicon Valley in San Francisco. And if you haven't been to the city, you don't know the difference. 10 years ago, that was the old people's city, right? And this was where all the young people wanted to be. Man, it's exactly the opposite now. And that place is going absolutely wild. The building, it's crazed, and it's not going to change. And there's a subtle difference. Well, it's not too subtle, but the big nexus of the high tech, networking, mission critical system software, whatever, that's down here. The nexus of the social, mobile, next generation business, that's up there. And there's a synergy between those two. I believe that, and I remember I told you, build out is where the value is created in the companies, but the value that's going to be created from society is going to be much bigger than that. So you all are going to be living through a great time. The next decade or 2 decades is going to see massive transformation, and every year seems like half this class ends up saying or ended up going into some entrepreneurial venture or some venture company, and so I look forward to working with all of you. And am I supposed to ask for questions?
When the companies that IPO'd versus stayed private shifted, how did it change?
Didn't stay private, got M&A. They got acquired.
Acquired. How did that change who won? Who made money?
Well, it didn't change much the money the venture capitalists made on winners. When that happened was also the bust period. Venture capital took their eye off the ball a little bit. First, there was a lot of downsizing going on. Second, as much as we love clean tech, every fund thought clean tech was going to be it, right? In 2005, there was a Churchill Club meeting here at Stanford, and was on clean tech, and so I was on the panel, and there were 2 others, and I was the no side, and I said, clean tech is a wonderful thing. It'll change the world. How many of you here have a Prius, right? And a few hands went up, and I said, so why didn't the rest of you throw away your cars to go get a Prius? It's changed the world. Venture capital lives on disruptive innovation. According to Drucker, disruptive innovation is a 10x better return. If it's only a 2 or 3 or even a 50% X return, it doesn't justify switching costs. So that's a long-term thing. Big companies, a lot of capital, et cetera. So venture capital did a horrible job in trying to find a new avenue to invest in. And but the returns, we just got $1 billion return on an investment that we'd already amortized, that was an acquisition by Amazon. You see these acquisitions, $20 billion, $10 billion, et cetera. So for the venture folks, it may not change the equation very much. For the companies, it actually does, because if you look at the study, there's been a study done on where's the greatest value created for unicorns. They go public, and it's in the first couple of years. Oh, that was here in the class last year. It's in the first couple of years after they go public where the value really, really, really goes up. So now that would say that all those who were acquired could actually be good enough to get those kind of returns. They may or may not be, but the real upside happens after. We went public at $365 million, And even if we only sold at 8 billion, that's a lot more than 365. All that went up. Value was created after the IPO.
So then the public, though, they don't get a chance. Like my mom can't make any money on it.
Oh, remember what I said? Most of the money is made from the IPO on. Now we've got a whole new thing called crowdsourcing, and you pick the right things there, you can get some value. The rules have changed a little bit, but you have to be an accredited investor to invest in funds and in startup companies, and that means you have to have, what is it, $1 million, is it? It's $1 million or multi-millions in liquid assets, not counting your cars and houses and anything else. So.
I think they just changed the law.
Yeah, I know they just did, but they haven't eliminated it totally. You still have to have that. They're trying to just trying to protect the, average investor. I mean, VCs. The rule of thumb sort of is, you'll have 5 to 7 failures. You'll have 2 to 3 living dead, and you'll have 1 to 2 that'll make the whole fund. So, if this was, the scores are more like baseball batting scores than they are, it's, and they're professionals. That's all they do. Is work on this.
When you said John Doerr, Netscape went to John Doerr to go public. How did they talk about the valuation of that? Did they just kind of give him some of their company and say, let's go public?
No, there's lots of ways to come up with valuation, but no, that's actually not how you do valuations when you go public. The reason you want to bring in someone like John Doerr is they've been through this a lot, and they know how to work with the investment bankers to get the best bankers to help get the best story. And the way the price is set when you go public is you have your investment bankers, and there'll be one lead who carries the book or the investment, and there'll be 2 to 5 or 6 others that are also trying to sell. The only reason you have investment bankers is to help you get your pitch out there, and to help you. What they are is salesmen. They're out there selling to all the funds and everybody they know. And now you go on this tour with them, and you give your pitch in front of all these folks. You'll do it 30 or 40 times, maybe even more. Then it's basically, this starts when you're first working with your investment bankers. You look at all the comparables that you think have gone public and where it is, and you try to windage of what the sentiment's going to be, and they pick a number to put on the cover of your S1, which is the booklet that you hand out. And that number, just pick a number, $20 a share. That's sort of like, this is our ask. And so now you're briefing everybody, and now what the investment bankers are doing, after the briefings, they're going back and they're working with them and saying, how many shares do you want at what value? So they create a book, and if it's even a reasonable deal, it'll be oversubscribed. And if it's oversubscribed, there'll be different amount of shares that these folks will get at some value. But if it's a really big deal, you may find the price goes from 20 up to 30 or 40. And then you get to after the last briefings on the last night before you're going to go public the next day, and you have the meeting with the CEO and the investment bankers, and you make a decision on what price you're going to go at. That means the next morning, the investment bankers will go out to all of their customers that are in their book, and they say, you're allocated X share at this dollar amount. And if it all comes in at the dollar amount you want, then what happens is the market opens, and now now these guys, it doesn't matter, you as the company are guaranteed to get that amount of money. You're guaranteed to get it, because the investment bankers have to cover that. But now when the market opens, this is a bidding market, right? You need buyers and sellers. So now the sellers are are all out there, and they're waiting for buyers. And that's why it takes maybe an hour sometimes or even longer for a stock to actually open in the morning, because what they're doing is they're trying to get the bid so it comes within a small range. It won't be opening like that. And at that point is what is what the market can buy it for. It's usually, if you do it exactly right, the investment bankers are trying to get a price that is X, and but then it opens 15% over it. They feel that they should leave a 15% room for the retail buyer to buy in that morning. Now, the company's only going to get that X. They're not going to get that extra 15%. I mean, that's the way it goes. But there is one other thing. If there's way too much demand, the investment bankers can have allocated 15% more stock above. And so now they can sell that additional as well and to help stabilize the price. I told you we went public at $6 a share. Then we went out and we did a secondary at $18 a share, where I sold the other half of the stock, which was way oversubscribed. So if we had gone public at my original price on the cover, we would have ended about 84 million. And by doing those two together, we ended up with 125 million. And we had a lot of happy shareholders because they bought at $6 and now it's up 3 or 4 times that. So, all right, question?
So I guess as you were walking through some of the IRRs over time, looking at kind of each period, it looked like there was a lot of variation. And so I was
These are average.
Yeah. So that's what one of my questions was, sort of what was that? Is it an average across all quartiles? And then I guess I'm thinking about how would it be measured today? And that leads to kind of the question, what would be considered a venture capital firm? So there's a lot of hedge funds and mutual funds starting to pour in at the kind of sizable end for the unicorn valuations, a lot of smaller investors.
There's a lot of money coming in from a lot of different sources, more than there even in the. There are more different types of instruments investing. Hedge funds have not done very well in the last 5 years since the bust. So they're looking for some way to try to get more leverage. And so we're seeing those folks come in. So there's a class of 5 to 10 VCs in this valley who have consistently had, almost all the time high returns. That's the Kleiners and Koshla and Sequoia and Excel and these guys, when they go out to raise money, they're actually allocating. Let's say if it's a $1.5 billion fund, that they first go back to all their original partners, and it will almost always fill up that fund. So they don't have to sell very hard. It's the folks that are newer and in the middle that end up having to sell hard. But there's still a lot of venture capital money out there, and there's a lot of other sources. And it's not just, there's money pouring in from Asia, from sovereign funds, that want to get into the valley. And, it's sort of a crazy time. Really hot deals get really overpriced, but that's such a small minority. It's our experience that the seed and A round, we're not seeing a lot of companies that are way overvalued. As a matter of fact, it's become, right now in the valley, it's actually very easy to raise seed money, and it's actually pretty hard to raise A money because there are so many deals. And you only can take on so much. We just started our 3rd fund. We were oversubscribed, but we took our first money a year ago, and we just closed the full thing. And there have been so many great deals. We got ahead of our skis. So we're going to stand back for 6 months and digest what we have. So you've got to pay. You have a pace for your investments. It doesn't matter how much money there is. Most of the big money that is coming in, they don't come in the Series A or the Series B. They're looking for the ones that, boom, this is a mezzanine. They're going to go public next year. I'll double my money and get out. So that they're not traditional venture. Yeah.
For more, please visit us at stanford.edu.